Hey there, everyone. Today on the final bar, a risk-off move for stocks as the NASDAQ plunges over 2%, just about 2%, on strong economic data. The 10-year yield reaches 4.8%, a level we've not seen since 2007. Jeff Hughes of JWH Investments is going to be joining us from Minneapolis. Wait until you hear his downside objective for the S&P 500. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we try desperately to make sense of these markets using the best practices of technical analysis. I got to use the verb plunges in the introduction. It's rare that I've been able to use that sort of phrase. I try to avoid that because it's sort of a sensational way of describing market activity. But the NASDAQ going down about 2% certainly feels like a plunge, and it feels like more of an acceleration to the downside. A lot of my recent conversations with our guests here in the Final Bar, with a lot of my peers in the industry, have talked about tracking this downtrend phase. And I think at this point, you have to accept that the short-term trend certainly is lower. And we talked about that even through yesterday's show, and that's even before today seeing continued decline. Now, what's interesting is you have to think about the difference between a short-term pullback and more of a long-term, more of a sustained break. And there are different ways we can try to do that. We can use trend-following tools, which is what we often talk about on the show. Things like moving averages and momentum indicators and trend lines and things to sort of track that trend and recognize when the tides are shifting, when things are starting to evolve, and when the trends are starting to change. The other way you can do it is start to anticipate those moves using something like an Elliott Wave toolkit to try to project future paths and then think about the different probabilities. Today's guest, Jeff Hughes, one of the best at trying to think about a framework for understanding how this recent pullback fits into a bigger picture trend. Perfect time to have Jeff on the show. I'm excited to get some of his charts in front of you and get his expertise as well. Let's get things started with our market recap. Let's look at what happened today on this risk-off move. A defensive sector actually at the top of the list today. Before we get to the market returns, I want to start with a poll. We asked you recently, will October 2023 be a positive or negative month for the S&P 500? Simple question, positive or negative? 61% of you said it would actually be a positive month. 39% said a negative month. I'm wondering if we asked this question in the last hour of trading today, what sort of answer we might have gotten, if it would have been anything different. But I respect the answer. And what's interesting about that question is it really plays to the seasonal tendencies that you have in September into October. A lot of major market lows have happened in the month of October. Is it reasonable to expect that October could actually see a major reversal and actually finish strong? Absolutely, yes. Let's look at a chart of the S&P and just sort of see where things are at, and then we'll get to the market recap and talk about it. So far, what's happened in the end of September, we ended around 42. We'll call it 42.80. Now, as we start the month of October, we're starting to rotate lower. So we're not too far off of that starting point. A positive month basically just means we have to close October over 4,300. That's not unreasonable. And I would argue that a lot can happen between now and then to actually create that rotation. I'd probably say a negative month, but that's only because I've spent the last couple days pouring through a lot of charts that drive home the negative tendencies that we've seen in the last 6 to 8 weeks. And I feel like I'm not seeing enough signs of capitulation, even on a day like today, to assume that this corrective phase is over. I still think there's downside to be had. So at this point, I'm not seeing it as a positive month, but let's let the markets tell us when that drop is going to be completed. With that in mind, let's look at what happened to the major averages today. The S&P finishing down 1.4%. That's ending the day around 42.30. The NASDAQ Composite was down over 2%, actually pulled up just a little bit going into the close, but still down about 1.9% for the day. Mid caps and small caps all down as well. And the small cap S&P 600, the worst performer out of the three S&P major U.S. indexes. The VIX was just above 20 a little bit ago. Ended up going back below 20 going into right into the close, but overall pretty close to what we would consider a volatile market, right? With the VIX over 20. And again, it's sort of a back of the envelope type of calculation, but generally speaking, the VIX below 20 is a low volatility environment. The VIX above 20, a high volatility environment. In my general assessment of volatility. So, the fact that we've sort of come up to that key level after being down in the low teens not too long ago, significant shift to be sure. Let's look at interest rates and all moving higher across the curve from the short end up to the long end. The long end of the curve well above 4.9%. The 10-year yield finished today just above 4.8%, as did the 5-year point. Look at a long-term chart of 10-year yields. You'll have to go back pretty far, back to pre-financial crisis period, to see the 10-year yield this high. Now, while that seems like an unreasonable, unbelievable level for the 10-year yield to be, I have my parents in town visiting from Cleveland, Ohio. They're a little bit older than I am. And as I asked them, talked about interest rates, they were telling me their stories of first houses they were buying, having interest rates quoted in the 10 to 12% range, and thinking that was kind of reasonable given that period of time. So it's all with that historical reference that we look at these rates. The fact that the 10-year yield is at 4.8% is still not that high relative to the long-term trend in rates. It just feels pretty high relative to the short-term recent history, right? The last 5 to 10 years. So keep in mind, rates certainly can go much higher. I know today's guest, Jeff Hughes, last time he was on, if I remember right, we were talking about 5.25 on the 10-year yield. So it'll be interesting to see if that still seems like a reasonable target, and maybe if we see higher rates in store going forward. The dollar, by the way, not too much of a change after a strong dollar has been the story here in recent months, sort of holding steady on the UUP. Not too much change from yesterday. Looking at commodities, a bit of mixed results today. The DBC, which is a broad commodity ETF, kind of an energy focus in that ETF, as most broad commodity ETFs tend to be a little more energy than anything else because of the size of that market. Down about 0.4%. Gold prices down about 1/3%. Silver prices slightly higher. Crude oil prices moving up as well. Finally, cryptocurrencies, a choppy, noisy period here recently in the last week for Bitcoin and for Ether prices. Bitcoin currently around 27,220, just above that level, and Ether prices just below 1650, both down slightly from yesterday's close. And that's after spiking higher on Bitcoin to around 28,500 yesterday. Looking at sectors, defensive at the top of the list, the utilities sector. Now, utilities have gotten bombed out in the last week, so this is up 1.2% after being down quite a bit. So let's not get too excited about this as a broad rotation to energy. I am seeing some bullish candle patterns in some of the utilities stocks. We have time in the market recap. I'll try to get to one or two of those just to show you what I'm talking about. But utilities, the only one of the 11 S&P sectors actually in the green. Everything else flat to down. Energy basically flat from yesterday's close. Materials down slightly, just less than 0.25%. At the bottom, we have consumer discretionary down 2.4%. REITs, or real estate, down 1.8%. And technology and financials, both down about 1.6 to 1.7%. Let's go back to that chart of the S&P 500, just sort of see where we're at. So, we've talked about this deterioration over the last, 6 to 8 weeks. The peak at the end of July, this first wave down when it feels like this is just another higher low. This is that real point where things start to get uncomfortable, or where you start to see a sign that this might not be an uptrend anymore, right? The dreaded lower high. And it's interesting when you have an uptrend, which is in good shape, like I think the S&P has been really since December of last year, making higher highs and higher lows. You're just looking for that pattern to change, right? You're looking for the market to try to make a new high and fail to do so. I would argue at the end of August, right into the Labor Day holiday, that's kind of what we saw. What happened after that is even more concerning, making the new low, right? Undercutting the August low. I think that was pretty transformational, certainly in terms of my perspective about the trend and where we were at. Now, there are a lot of different ways we can label this. We'll get an Elliott Wave take here in a bit from Jeff Hughes. I'm seeing this primarily as a head and shoulders top. If you measure the height of that pattern, it's about 6%. You subtract that from the breakdown around 43.50. That gives you a downside objective around 40.50 to 40.70, depending on how exactly you'd want to measure that. That would get us below the 200-day moving average, which almost got reached today. Not quite on the S&P, holding just above there, but that's a level around 40, 240, 180. That's the first Fibonacci retracement level. That's the 200-day, all right at this potential area of support. So when I think about levels of downside support as the market rotates lower, this 4,200 level, one we were paying attention to, I would argue we're kind of right about there. We'll see if that's able to hold through the course of this week. If not, certainly suggests to me we're opening up the door to further downside potential. Also note how the momentum has just classic rotation from a bullish phase where the RSI rarely gets below 40 to a bearish phase where it doesn't get above 60 on rallies. I think that tells you a lot about just this changing season that we've seen, certainly going into more of a decline phase. Again, going into one of the weakest months for stocks, October. Let's look quickly at breadth. And we talked a lot about breadth yesterday, so I don't want to beat this one too heavily, but I just wanted to point out that the indicators that we talked about, the percent of stocks above their 200-day, the percent of stocks above their 50-day, continuing to decline. One of the questions I got asked from one of my premium members at Market Misbehavior was looking at the S&P, this particular breadth indicator getting down to single digits. And does that mean that the downtrend is over? And my short answer is no, that just means it's gone down a lot, right? And I think that's a common misperception, right? We see an RSI become overbought or oversold, and we think that's the end of the move. And it certainly could be, but all that tells you is that a trend is in place and it is really pushing that direction hard. This has gone down to single digits. The last couple times that happened was in late September, in mid-June, and I would argue that the real signal on an indicator like this, which is more of a short-term signal more than anything, is not when we get very low, but when we stop going down, right? When we come out of that beaten down level. So this indicator getting below 10% and then getting above 10, 15%, that's what really marked the end of these corrective phases. So when you think the primary trend is now down, which I think it is, you're just looking for signs that that downtrend is reversing. And for now, breadth indicators like this just tell me we are in a decline. It confirms the negative breadth conditions. It confirms this distribution phase. It confirms that most stocks are actually going down and not able to hold key levels of potential support. Another indicator we've talked about is the bullish percent index, which uses point and figure charts as a way to measure breadth. It's worth noting that as of today, just barely below 30%. For us, this is a key level. If you look back, we've shaded in green just in the last 2 years, every time we've gone below 30%. And again, the signal is when we come back above that 30% level. That has identified some of the major bottoms that we've seen over the last couple of years. And if you go back even further, you'll find that's a pretty good signal for corrective phases and when they may be over. So again, all this tells me is we are in a corrective phase and it's not done yet. It would be done, according to this indicator, when we go below 30% and back above. We're kind of right at that point. We're just still confirming this downtrend. Let's look at some of the individual stocks on the move here. I wanted to highlight Airbnb. Airbnb is one of the names down today, more than the market. It's down about 6.5% compared to the S&P and the NASDAQ, down in the 1.5% to 2% range. What's interesting about this chart is you can draw this consolidation pattern. You usually call this like a coil pattern or a symmetrical triangle pattern, and it really could happen in either direction. So either the market's going higher or lower when you enter this pattern. And what marks a coil pattern is it basically is an equilibrium, right? It's a pattern of lower highs and higher lows. So it's a consolidation. The range is coming in. So I don't have Bollinger Bands on this chart, but if I did, the Bollinger Band's probably coming in a little bit. The bandwidth is narrowing, which tells you a lower volatility sort of period. We're basically settling in around $140 a share. And if you think about what this means, I guess behaviorally, the market rallies to 140 and then keeps going. And then all we're doing is we're overshooting and undershooting that 140, what we call an equilibrium level. The question is, what comes first, a break above the upper trend line or a break below the lower trend line? Because one of those two things is going to happen, because at some point the triangle comes to an end called the apex. You can't go any further. So usually, what I remember John Murphy teaching me years ago was 2/3 to 3/4 of the way through that pattern is normally when you get a break. There's no real indication from the pattern itself as to which way we break. I've learned to be patient and see, do we break above the upper boundary, break below the lower boundary? Today, we're gapping down and breaking below the lower boundary. So overall, charts like this, I would argue, are more validating this corrective phase that we're in for a market, right? In bullish phases, you find a lot more breakouts. You find a lot more consolidation patterns resolving to the upside as we sort of reinitiate the uptrend. Here we're seeing the opposite, where the pattern is actually resolving to the downside. So more of a distribution pattern for Airbnb right now. Have to bring up charts like Amazon, of course. When I'm looking at the FANG stocks or the Magnificent Seven, Amazon, I think today was one of the worst performers. Might have been the worst out of that group, down 3.7%. What concerns me about a chart like Amazon is that it had looked so good up until mid-September. And when you ask, what's changed in this market, from August into September that has made this, the picture evolve, what we call a change of character, where things looked a certain way July into August, and now September into October, they look differently. Amazon might be one of those examples, and you had signs of concern on the way up because you had this bearish momentum divergence, higher highs in price, lower peaks in momentum, but the RSI was remaining pretty constructive. We were holding an ascending 50-day moving average. That's not a bad chart. That's actually a pretty decent chart, but we gapped below the 50-day a couple weeks ago, and now we've continued lower, swing highs and swing lows, all declining. We just bounced up to 130, and today rotating lower, closing just below 125. So overall, I see this as a chart just maybe beginning that swing downwards. We've now made a lower low. We bounce higher. Do we say a lower high? Do we remain below the 50-day moving average, which is now sloping downwards? This is how the chart of Amazon has started to evolve. Also want to point out Netflix, another of the S&P names, down a bit. Now, this is an interesting candle pattern, actually. This is the chart of Netflix. Let me switch to a candle pattern here, and I'm going to make it a little shorter time frame just so it's a little easier to see it. So let's go to like a 6-month chart, perhaps. Does anyone know what this candle pattern is? Boy, it's changed a little bit since I was looking at this earlier, but I would still say probably satisfies it. You could actually call this one of two things, to be honest with you. I'd probably go with an inverted hammer. So what that means, if you know your candle charts, is in a downtrend, you have this pattern where the open and close are near the lows. You have a minimal lower shadow and a long upper shadow. A more ideal version would have really no lower shadow on there and a long upper shadow. I'd probably still label this an inverted hammer candle. That usually indicates a short-term bottom. What's interesting to me is this pattern is happening right at the 200-day moving average. Now, you could also certainly call this a doji candle, which is when the open and close are almost at the same levels. There's no real gap between the open and the close. You saw a similar candle a couple of days ago. So Netflix has now pulled back to a key moving average to the 200-day, but you're finding these short-term reversal candles, which may suggest a bit of a short-term bounce here. Overall, again, I still see this as a chart in distribution because lower highs, lower lows. So maybe this marks a bounce back to make a new lower high. Maybe we retest the 50-day, but for now indicating some downside exhaustion right at the 200-day moving average. First Energy, FE, I mentioned just to wrap up our market recap, some of the utility stocks showing a bullish candle pattern. Anyone know what this pattern is? By the way, we have our chat open. Drop in the chat if you know what this pattern is right here. This is where you have a down candle followed by an up candle. It happens in a downtrend. We don't engulf, so it's not a bullish engulfing pattern. There's hint number one, but we do get at least 50% of the way through that first candle. It's actually called a bullish piercing line if you want to know your candlesticks. And if you don't know your candle patterns, click on the little magnifying glass, type candle patterns. Some great articles describing some of these with some good examples. But this on First Energy, some of the other utility stocks that have gotten so beaten down, suggesting maybe some short-term strength here. I want to bring on today's guest, Jeff Hughes. Before we do so, a couple quick announcements for you. First off, our mailbag is always looking for some more questions. We've gotten some great ones from you guys recently. Really appreciate you helping us help you navigate these uncharted waters. Email is the best way to get your questions to us, thefinalbar@stockcharts.com. On X, just tag us in a comment @FinalBarSCTV. On YouTube, you have a couple choices. Put a comment below the video that you're watching. Any of our shows like this one that has a chat that is now open, just drop a question in the chat. We actually had some really good questions in the chat yesterday during our live broadcast of the Final Bar. One of them so good, I will actually be posing it to my guest today, Jeff Hughes. So if you want your questions answered, make sure that you put them in there. We do have the super chat turned on. So if you want to make sure we absolutely answer your question, we will do so. Just pop it in there. Also, as a reminder, our next live Q&A will be happening this Wednesday. That's tomorrow, 1 p.m. Eastern, 10 a.m. Pacific. I'll have a couple charts queued up to get started, and then we'll go all from the chat and have a live Q&A. Wide-ranging discussion. We can go anywhere you like, anything about technical analysis, market dynamics, whatever it is. So tune in tomorrow, 1 p.m. Eastern, here on our YouTube channel for our next live Q&A. I want to welcome on today's guest, Jeff Hughes. Jeff's the Chief Investment Officer at JWH Investment Partners, coming to us live from Minneapolis, Minnesota. Jeff, good to see you. And thanks for bravely coming in on a distribution day like we saw today. How are you?
Well, I'm great, Dave. It's always a pleasure to be here. Thanks for having me on the show today.
No, it's good to see you. And I appreciate your perspective. I think a lot of people are struggling with how things have changed so much. You have come on the show previously this year and talked about the downside risk that may be there. Now we're starting to see some of those patterns really come into fruition. So I'm really interested to see how you are interpreting what we've experienced here in August and September. We're starting with what I call a performance chart or a perf chart, looking at the FANG stocks or the Magnificent Seven. What does this tell you about the leadership themes here so far going into the fourth quarter?
Yeah, on the far right, you can see the S&P 500, which is that barely noticeable performance there, plus what, like 11.6% or something. Last I looked. The interesting thing to me is just to the left of it is Apple and Microsoft, the two worst performers of the FANGs. Yet they have tripled the S&P's performance themselves, and they are the heaviest weights in the index. In fact, if we look at all seven of these stocks, now known as the Magnificent Seven, the concentration is like 27% of the S&P 500. And you might find this difficult to believe, but on an index weighted basis, the Magnificent Seven have accounted for 141% of the S&P's year-to-date performance through yesterday's close.
So no doubt it's been the mega caps and everything else. We've seen that, and what a brilliant way of sort of illustrating that. Now, your second chart, another perf chart, sort of comparing these FANG stocks to everything else. What does that tell you here?
Well, the one thing it tells me is that the vast majority of stocks in the S&P 1500 are not participating at all. In fact, outside of the S&P 500, the NASDAQ 100 and the FANG stocks, if we look at mid caps and small caps, by and large, they're unchanged year to date. If we look at the value line geometric index of 1,700 stocks in the S&P, and it's basically equally weighted, and the daily change is kind of the median price change. It's negative year to date. And in fact, the S&P equal weight index is also negative year to date. But not to be ignored, the KBW regional bank index is down some 23 to 25% last I looked. So, there is a clear bifurcation between the winners and the rest of the market.
I love this visualization. I hadn't really thought about the year-to-date returns in some of these indexes versus, I mean, talk about a completely different world from the left side to the right side. Let's talk a little bit more about
Let me just add one point, Dave.
Please.
One point I forgot to mention is that 55% of the stocks in the S&P 500 index are negative year to date.
Ooh, okay, that hurts a little bit, Jeff, when you describe it that way. And we're getting close to releasing our new market carpet. One of the things we've been looking at just to test it is our year-to-date returns. And I mean, it is a very mixed and modeled view. If you take the biggest weights out and look at the rest of the S&P 500, not a particularly green heat map year-to-date for sure. I think it speaks very well to what you just said. Can we dig into the Elliott Wave pattern a little bit? We're starting with a weekly chart of the S&P equal weight index. Where are we at here in this phase here?
Yeah, first let me just explain why am I using the equal weight index? Well, it takes out that concentration bias of the Magnificent Seven, and it makes the pattern slightly more manageable. And certainly from a visual perspective, you can kind of see what's really going on under the hood. So if we set the Wayback Machine all the way to, say, March of 2020, where we got the COVID crash lows, that advance into the January 2022 highs basically marks what we've described as cycle wave 5 of a super cycle advance that we think began back in 1932 and went on for a 90-year period, a GAN 90-year cycle. And since January of 2022, we have been tracing out a corrective waveform that we think is going to most likely trace out 5 waves down to begin. And that 5-wave decline will probably only be cycle wave A of an ABC that takes years to completely resolve. Now, we think that the decline into the October 2022 low was just primary wave 1 down of that 5-wave Elliott Wave impulse pattern that we're expecting. And the retracement that we saw completed in July of this year retraced a Fibonacci 78.6% to the penny. We count that as a double zigzag WXY is the labeling. It's slightly different in the cap weighted index, but the timing is exactly the same. And what we believe is underway right now are the very early subdivisions of primary wave three down, which we
Mm,
believe once we take out the 200-day moving, 200-week moving average, which is just a couple percent below where we're at today, we should open the floodgates, and this should be a complete washout that carries stock prices to, epic lows, possibly as far down as, what we believe could even approach the prior COVID crash lows.
oof. And it's interesting, the 200-week moving average on the equal weight served as support in October 2022. That was the low there. So we're right back at that same point. Interesting symmetry, that Fibonacci level I'd not seen. That's a great point, Jeff. Let's look at the daily S&P chart and help us make sense of this wave from the July peak. How are you counting this retracement lower?
Yeah, from the July peak, we're looking at this as the early iterations of what will be intermediate wave one down of primary wave three down. And so, what we've done is we've identified kind of the initial decline as minor wave one, the rally back into the August, September highs rather. That would be minor wave two. And since that time, we've seen the market trace out what looks like five waves down.
Mm,
And that looks like it could potentially be just part of minor wave three. So, we've got kind of a working hypothesis right here. And what we've traced out are, a few um, iterations that we think could, illustrate how the market will trade to complete this intermediate wave one decline. But it doesn't have to do that. One of the things that has our attention are very specific cycle turn dates that are illustrated in red.
mm,
And if you're familiar with the work of Paul McCray Montgomery, Paul's one of our market heroes. He, had a 50-year storied career on Wall Street, making some of the most profound market calls, including the crash of '87. And one of the things that's starting to line up is basically the same cyclic conditions that existed back in '87. Now, this
mm.
is actually our bull case, Dave. Our bear case is that the market just careens lower. And
Mm.
we think that that's not too far from the realm of possibilities. We're just about at the 200-day moving average. We could catch a bid there, and that could rally the market into the October 14th cycle turn date. From there, we would expect the market to turn down, hard down, basically. And the next cycle turn date comes into play at about October 28th. Now, that could also connect some support around the 377-day moving average.
Mm.
That is a Fibonacci number, as you probably recall. It also would mark the level that we think is consistent with the head and shoulders top that is now evident.
Sure.
And that measured move down carries to about, I think you said earlier, 4,070. That's the level we're thinking about as well.
But you covered so many great things in there, and thanks for mentioning Paul Montgomery. What a legend! That his newsletter, Universal Economics. I used to love reading that when it would come. I mean, he had some incredible quotable moments in that newsletter. One of the questions we got on the show yesterday that I love to pose to you, Jeff, and again, everyone put questions in the chat as they come up, and we'd love to consider as many as we can. One of the ways that you could label this is sort of an ABC, right? Sort of an initial move lower, a wave B higher, and then a wave C lower. What compels you to not label it as that sort of three-wave pattern and think of this more of a wave three that's part of a larger, I guess, impulse move lower?
Yeah, so if we count the wave move off the October low
Mhm.
into the July high, we can't count that as an impulse. We count that as an ABC, as a zigzag. And you could see wave B was this tremendous 4-month flat pattern, right? And from that, we can count 5 waves up, but that just ends, intermediate wave C of primary wave two. We think that completed primary wave two, and we're already getting to the point where it's getting a little extended for a corrective waveform.
Mm.
It's not impossible. We haven't eliminated that as a possibility. If it did break out above the July 27th high, then it would probably be indicating a triple zigzag rather than, or a double zigzag rather than a single zigzag. in the case of the S&P cap weight index. I don't believe that's going to play out. I think it's a very low probability. Just take a look at the momentum readings right now. And this is, we use Martin Pring's tool, the No Sure Thing, which is a multi-period momentum oscillator. And we're just below the median line. And it looks to me like there's a lot more downside for that momentum indicator to carry.
This is at the bottom. That's the Pring No Sure Thing indicator at the bottom. Yeah, that's great.
That's
And
correct.
yeah, thanks for relating that. And I love that. I love what you said there, Jeff. And I think what you're saying was, if this is a big wave 2 on the way up, that means we're in a wave 3, which means you're in an impulse wave going lower. So you really have to count that as more of a 5-wave structure. And I love combining the momentum with that. It's a really, really good way of framing that out. With the time we have left, just a minute or two, talk to us about rates, because I know, so many people have asked about rates. I feel like all the way up, people keep asking me, is that it? Is that it? And I keep telling them rates can go up a lot, right? Just relax, because it can go higher. What do you see now that helps you understand where yields may go forward?
Yeah. Well, as you may recall, last time I was on your show was August 3rd, and the 10-year Treasury was yielding around 420 back then. And at that time, I said, I think the breakout above 410 gives us a measured move to about 5.25, right? Today, we're at 480. I still think there's more upside to rates. And one of the reasons I think that is if you look at the lower frame of this chart, we're looking at the MOVE index. The MOVE is kind of like equivalent to the VIX, but to the bond market. It's bond market volatility. And each time we've seen rates move up to a peak and then reverse, we've seen that kind of move. That move has been attended by an upside move in the MOVE index itself, above 150%. And we're just not there yet. The MOVE index is hovering around sub 130 right now. So I think there's plenty of upside potential for the MOVE index. And once we see it start to crest above that 150, we'll probably be looking or on alert for a reversal in yields. It's not a perfect coincident indicator, but at least tells you that you're in the neighborhood and, allows you to, get your spidey senses tingling, so to speak. But I think we'll probably push up to around 5.25 before this particular leg of the advance in 10-year yields is complete.
Jeff, this was awesome. Thanks so much for taking the time to go through some of the wave counts. Really helps to sort of illustrate a structure to what we've all experienced. Thanks for dropping some wisdom on a distribution day. Stay safe and be well there in Minnesota. We'll talk to you again soon.
Thanks, Dave.
That's Jeff Hughes. Jeff is the Chief Investment Officer at JWH Investment Partners, coming to us from Minneapolis, Minnesota. As you know, if you've watched the show for a while, I don't use Elliott Wave day to day in my work. I have always found so much value in talking to people like Jeff Hughes, who live and breathe that sort of approach and understand it more deeply than I ever will. But being able to think about what sort of conclusions he's able to draw, how that fits into some of the pictures of momentum and breadth and sentiment that we've been talking about, I find so helpful for having a good, well-rounded approach to understanding market structure. Great take there by Jeff Hughes at JWH Investment Partners. We've got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. When I was looking at Jeff's charts before we went live, he had an equal-weighted S&P chart, and I was inspired to do an equal-weighted QQQ just to show, again, as I'm taking a step back, what's your initial assessment of this chart? And it's for me, we've had a clear 3-wave distribution pattern for now, but a day like today tells me we may not be done yet. Now, with the S&P, we talked about the wave structure, we talked about the head and shoulders pattern, the 200-day moving average. Interesting to note on the equal-weighted QQQ, we're nearing that first Fibonacci retracement level, which is just below $72. We're also right above the 200-day moving average, right here around 72.60. We break those levels, and there's really nothing left to consider besides further downside potential. Now, the 50% and 61.8% retracement levels have been price support as well, which means I would be initially looking for a downward move to 69, maybe an eventual downside target just above 66. But think about what that additional distribution could mean for the NASDAQ. And again, this is an equal-weighted NASDAQ. So thinking not just about the FANG stocks, the Magnificent Seven, but the other names as well. I think there's further downside to be had if we are unable to hold key support. This is a chart I'm watching this week. Chart number 2, I love how Jeff Hughes evoked the MOVE index, which is sort of a VIX, a volatility measure for bonds. Looking at volatility for stocks, we traded above 20 today on the VIX. We did not close above there, so we're still technically in a low volatility environment, as I would loosely describe it. A VIX closing above 20 is a very different feel than we've had for stocks in quite some time. The last time we spiked above 20 was back here in March when we had a bit of a further decline here. Similar, actually, in a lot of ways to what we saw. It was about a 6-week decline before we rotated higher, but look how high the VIX was. It actually touched 30 here at the March low. We're nowhere near that. We're actually a VIX just at 20, and we're already sort of having this this decline. I'm concerned about what happens when we get to a high volatility environment, what that might mean for further deterioration for stock prices. Finally, I love looking at candle charts. I think it's one of the more visually rich parts of the technical analysis toolkit. I love data visualization tools like the relative rotation graph, the RRG that we've talked about, heat maps, our market carpet, which our new version of that coming out very soon, I think will help you really understand performance and technical analysis at a high level for a group of stocks and ETFs. Candle charts are a great visual representation of day-to-day dynamics, and I'm seeing a lot of short-term reversal candles, some utilities finding bullish piercing line candles over the last couple days after the distribution, a nice rally today. I'm seeing doji candles and other similar types of patterns on charts like Netflix. Now, when you have a candle pattern at a key moving average, that usually gives a little more validity to the idea that we could have a short-term bounce here. But keep in mind, that is a short-term indicator. 1 to 3 bars is all it's really trying to tell you. Overall, lower lows and lower highs are what are happening for Netflix. That is, by definition, a downtrend. Thanks so much for joining us today on The Final Bar and every weekday after the close. A special thank you to Jeff Hughes of JWH Investments joining us from Minneapolis. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.